Welcome to the Deep Dive. Our mission here is pretty simple. You give us that stack of complex research, and we cut right through the noise to get to the essential strategic insights. The stuff that actually moves the needle for a sophisticated, critical investor like you.
And today, we're doing a deep forensic analysis of, well, the undisputed heavyweight champion of the built world, CBRE Group, Inc.
This is a mammoth organization.
Oh, it's huge. We're talking about a company that's getting close to a $50 billion market cap, with trailing revenues north of $39 billion as of late 2025. It is, for all intents and purposes, the essential infrastructure layer for global commercial real estate.
Okay, so let's unpack this. We're dissecting the core investment thesis through the lens of a really compelling analysis we've seen, titled Analyzing the Hegemon's Moat, the ROIC Problem, and the Data Center Supercycle.
And that title right there, it just sets up this profound internal contradiction, doesn't it?
It absolutely does. And I think understanding the paradox is really central to the entire investment case here.
It is. CBRE is often called the fortress of the corporate services world. I mean, they service over 90% of the Fortune 100. They have scale, data, switching costs, all the things that define a real structural moat.
But,
and it's a big but. Despite these, seemingly unassailable advantages, the firm is navigating a really painful and volatile transition away from the easy money era.
that era being, of course, the decade of near-zero interest rates, a massive artificial tailwind for the entire industry.
Exactly. It inflated asset values, it crushed cap rates, and it just made transactions flow like water. Now we're in a completely different world, a high-rate normalization environment where the cost of capital actually matters again.
Right. So the core question the market's wrestling with, and the one we have to answer for you, is whether CBRE's deep structural advantages are actually strong enough to justify the quality premium valuation the stock has right now.
That's it. Is this just the best house in a really tough neighborhood, a cyclical sector under huge stress? Or is it a true secular compounder that can create value no matter what the cycle's doing?
To get to the bottom of that, we've synthesized the source material into three critical pillars that really define the investment thesis for CBRE today.
First, we need to rigorously test the durability of the economic moat. How real are those scale advantages and switching costs? Second, we have to quantify the strength of the secular growth factors. We're talking AI, data centers, green energy. Are they powerful enough to decouple the company from the struggling office market?
And third, we're going to perform a really critical audit of their capital allocation quality. We'll weigh the big M&A successes against some of their persistent quantitative challenges and some of their very public failures.
Let's get into it.
All right, let's start at the most foundational level. The complete strategic transformation of CBRE's business model. Historically, commercial real estate brokerage was notoriously volatile. The whole business lived and died by what the analysts call the kill.
The kill, yeah. That was the huge, lumpy commission. The 3% fee on a $500 million investment sale, or that massive leasing commission when a big bank signs a 15-year lease.
It was a feast or famine model.
Totally. High margin, high beta, purely transactional. If GDP hiccuped, or more importantly, if interest rates spiked, that bid-ask spread would just blow out, sales would freeze, and that high-margin revenue would just fall off a cliff.
And CBRE realized this basically made them uninvestable for anyone looking for long-term compounding.
Exactly. So their deliberate strategy, which has been playing out for decades, was this brilliant effort to shift from living by the kill to guaranteeing they keep the client. They wanted to embed themselves into the client's operating budget.
OpEx over CapEx.
That's the key distinction. And this shift really solidified with their aggressive push into facilities management and outsourcing, which climaxed with that 2015 acquisition of Johnson Controls Global Workplace Solutions, the GWS business.
I remember at the time, there was some criticism that they were buying a low-margin business, that it was going to dilute their traditional profitability just for the sake of stability.
There was. But it turned out to be a necessary sacrifice and, frankly, a masterstroke in de-risking the entire company. We just can't analyze CBRE today without acknowledging this fact. GWS is not some bolt-on service anymore.
It's the core.
It's the core. It now generates roughly 70% of the firm's total revenue. That was $25.14 billion in 2024. CBRE is now, mathematically, a facilities management company that provides these mission-critical services, and it also happens to operate a best-in-class brokerage arm.
That just fundamentally alters the risk profile. You go from high cyclicality to something more like a utility.
It does. GWS is all about operational entanglement. It's everything from integrated facilities management, HVAC, security, janitorial, to really complex technical stuff like managing manufacturing sites or, and this is crucial, data centers.
And these contracts are huge, multi-year, covering millions of square feet across dozens of countries.
And that's where you get those incredibly high retention rates, often cited as being over 90%. The switching costs are immense.
Right. It's not like changing your cell phone provider.
Not at all. When a Fortune 100 company outsources this stuff to CBRE, they're transferring staff, they're integrating proprietary IT systems, linking up all their vendor relations. Trying to unwind that relationship is it's immensely disruptive.
Clients just aren't willing to risk that operational chaos to save a few basis points on cost.
Rarely. And that gives GWS this annuity-like, predictable baseline of cash flow. We saw it so clearly in the recent numbers. I mean, Q3 of 2025, transactional markets are still kind of reeling from rate shock, and GWS revenue grew a very solid 12.6% year over year.
That's incredible. And that growth is internally driven, it's secular, it doesn't depend on asset prices going up.
Nope. It depends on the relentless corporate need to outsource non-core activities to global experts to save money. It's a pure outsourcing tailwind, and it provides that counter-cyclical ballast the old brokerage model so desperately needed.
Now, we need to throw in a serious word of caution here, something the source material really hammered home. For any investor just looking at that massive top-line revenue number, and that's the distortion from pass-through costs.
Yes. This is where you have to put on your forensic accounting hat, especially if you're comparing CBRE to its peers. Gross revenue is highly misleading.
So what are pass-through costs exactly?
They're costs CBRE incurs on behalf of the client. So reimbursements for labor, for materials, for subcontractor fees that they organize. The crucial part is CBRE just invoices the client for these costs. At cost, they carry zero margin.
Zero.
Yeah.
Can you sort of model that for us? Why does it mathematically change the picture so much?
Sure. Think of it like this. CBRE bills a client $100 million for facilities work. Maybe $5 million of that is the actual fee for CBRE's expertise, and that fee has a, say, 20% margin. The other $95 million is just used to pay for the security guards, the utilities, the materials. That's the pass-through.
So they report the full $100 million as gross revenue.
Right, but only that $5 million fee actually contributes to their gross profit. Since the $95 million is in both revenue and cost of goods sold, it just artificially crushes the reported net profit margin down to that very low 3.1% number you see.
And the scale of this is immense. In Q3 2025, out of over $10 billion in gross revenue, more than $4 billion, over 40% of the top line was this zero margin pass-through.
Exactly. So for you, the sophisticated investor, this means you have to normalize the analysis. You have to look at net revenue, which strips those costs out, and you have to focus on core EBITDA margins to see the real profitability of the value-added services they provide.
If you don't make that adjustment, you're just getting a completely distorted picture.
Completely.
And pivoting quickly to the cyclical side, the advisory business. The fact that segment saw a 13% revenue jump in 2024 is, well, it's pretty significant, isn't it?
It is. That growth signals a definitive, if maybe fragile, recovery from the cyclical trough we saw after the 2023 rate hikes. And that 13% growth, it directly contradicts the most bearish narrative out there, the whole death of the office story.
It shows that high-quality assets are still trading hands.
They are. The sector is bifurcating. It's not collapsing entirely. So to sum up this first part, the key takeaway is that the earnings profile is now this deliberately engineered mixed bag.
You've got the high-beta advisory business, but it's anchored by the secularly growing, stable GWS engine.
Precisely. They've built a model that is structurally designed to be less volatile during credit cycles than any of their pure-play brokerage rivals. They are the resilient anchor in the sector.
That stability narrative is powerful. But now we have to pivot to the part of the analysis that poses, I think, the biggest philosophical challenge to the CBRE bull case, the financial health metrics, specifically this return on invested capital problem.
This is the critical quantitative exam for any experienced investor. We're moving beyond just revenue stability to the core metric of genuine long-term value creation.
And the principle is sacrosanct.
It is. A company only creates value for its shareholders when its return on invested capital, or ROIC, exceeds its weighted average cost of capital, the WACC. If ROIC is less than WACC, you are technically destroying economic value on the capital you've deployed. Doesn't matter how fast your revenue is growing.
And the data for CBRE here is frankly alarming for a company with its blue chip reputation.
It's the source of major friction in the valuation. We've seen this dangerous divergence happen since the rate environment changed. Back in 2021, CBRE had a comfortable positive economic spread of about 2%.
So ROIC was 2% higher than WACC.
Right. But as of late 2025, the trailing 12-month data shows CBRE's ROIC is at approximately 6.9%, and its estimated WACC is about 10.7%.
Let's just pause on that. A negative spread of almost 4%, that is substantial. The rising cost of capital has just completely outrun the firm's ability to generate returns on its capital base.
Absolutely. And we need to understand that 10.7% WACC figure. The cost of capital is driven by the cost of debt and the cost of equity. And while CBRE's leverage is low, the cost of any new debt has skyrocketed.
But it's really the cost of equity, isn't it?
It's mostly the cost of equity. The market's required rate of return, the hurdle rate it demands for taking on the risks of this specific stock, has gone way up because of market volatility and the perceived risks in commercial real estate. That 10.7% is the market yelling, we need a double-digit return to justify holding your stock right now.
And if they're only generating a 6.9% ROIC, the market is subconsciously pricing in the fact that the platform isn't clearing its hurdle rate. This is the financial argument against that quality premium.
Precisely. This negative spread is a fundamental challenge to the whole secular compounder story. It puts immense pressure on management to either drastically improve efficiency or, frankly, just stop spending money on M&A until the spread turns positive.
Now, to be fair, we have to talk about the distortion in that ROIC calculation. The denominator, invested capital, is inflated by a lot of goodwill from past acquisitions.
Yes, that's a key point. The balance sheet has about $5.6 billion in goodwill intangible assets from deals like GWS and the very successful Turner and Townsend integration. And goodwill is, by definition, non-productive capital. It inflates the denominator and artificially pushes down the calculated ROIC.
So a tangible ROIC, if we stripped out that goodwill, would look a lot better.
It would, for sure. But even if we adjust for that, the pressure from that stubborn 10.7% WACC, it's still the dominant constraint. You can't just argue away your cost of capital. You have to actively raise your operational return above that high hurdle rate.
This connects directly to what the CEO was saying back in 2024. He admitted GWS costs had increased at an unacceptable rate.
That comment makes perfect sense in this context. They were fighting wage inflation and tech spending, and they realized they were deploying capital that just wasn't generating enough return to justify a 10.7% cost. They were running fast, but falling backward economically.
And we have seen some recent stabilization in margins. Core EBITDA was up 19% year over year in Q3 2025, which suggests those cost-cutting programs are starting to take hold.
They are, but cost-cutting is the short-term fix. The long-term fix is deploying capital more efficiently into high-return areas, and maybe even divesting some low-return assets to improve the aggregate ROIC.
It's so important, though, to contrast this quantitative headwind with the company's actual cash generation. It's just immense.
And that's the financial beauty of this capital-light services model. Despite the ROIC problem, CBRE is a cash machine. Trailing 12-month free cash flow was nearly $1.5 billion.
And that's because, unlike a REIT, their net capex requirements are minimal. They don't have billions tied up in physical buildings.
Exactly. Their capital is tied up in people and software, which has a much faster payback. High cash conversion and low leverage safely at 0.93x gives them tremendous financial flexibility. They can fund operations, M&A, and buybacks without stressing the balance sheet. They're highly resilient even if they aren't maximally efficient at this exact moment.
Okay, let's shift gears now and focus on the future. If CBRE is going to reverse that negative spread, it has to lean into its secular growth vectors. And nothing is more exciting right now than the data center supercycle. This is the AI tailwind applied to the built world.
This is by far the most compelling growth story in the entire analysis. CBRE's scale and integrated model make it uniquely positioned to monetize the data center boom across the entire asset lifecycle.
And this isn't just a high-growth vertical. It's high margin, too.
Very high margin. And their ability to deliver a full-stack offering is what sets them apart.
Walk us through that. Where do they get involved in the process?
It starts at the very beginning, with the land and the power. Their subsidiary, Trammell Crow, handles site selection. And this is a hugely complex process of finding massive land parcels and, critically, securing the enormous power grid capacity that these hyperscale centers need.
And once the site is ready, their big acquisition, Turner and Townsend, comes into play for the construction phase.
Right. T&T manages the construction and project management, the physical build. And then once the shell is up, GWS shifts into operational mode. They manage over 800 data centers globally, ensuring that mission-critical 99.999% uptime that the tech giants demand.
They even handle the specialized work inside the buildings.
They do. They bought a company called Direct Line Global that handles the white space installation, placing the server racks, the cabling, managing the cooling. This full integration just locks the client into CBRE for decades. It's highly profitable recurring revenue.
The numbers are staggering. Data center leasing revenue more than doubled year over year in Q3 2025. Management thinks this one sector could be over 10% of total earnings very soon.
It's pure, profitable diversification, and it's completely uncorrelated with the office cycle. The AI boom is creating effectively zero vacancy in primary data center markets. CBRE is capturing value at every single stage. This is the definition of leveraging scale to ride a secular tailwind.
And speaking of Turner & Townsend, let's circle back to that deal. The analysis calls it the single most successful capital allocation decision of the last decade.
I think that's warranted. The initial acquisition in 2021 and then upping their stake was strategic genius. T&T is a global firm specializing in program management and cost consultancy.
So what made them so vital? What do they bring that CBRE didn't already have?
They provided immediate, credible entry into the high-margin infrastructure and green energy sectors. T&T manages massive projects. Think airport expansions, public transport grids, renewable energy infrastructure, EV battery plants.
So they're riding the wave of government stimulus and the energy transition, which has nothing to do with commercial office demand.
Nothing at all. And the performance shows it. T&T has grown revenue at a compound rate of over 20% since the acquisition. It's a genuine high-growth engine that's completely uncorrelated with the old CRE cycle.
And this incredible synergy leads us to a really crucial structural change.
Yeah.
The 2025 segmentation restructuring. This is a direct attempt to capitalize on that T&T success.
It is. This is management sending a clear signal to Wall Street, basically inviting a sum-of-the-parts valuation. They're breaking out project management as its own standalone segment.
So it's no longer hidden inside the massive lower multiple GWS division.
Exactly. The high-margin, high-growth T&T business was buried in GWS.
Yeah.
By making it visible, management is hoping the market will re-rate it and assign it a much higher multiple, maybe something closer to an engineering firm like AECOM. This is a strategic move designed purely to unlock valuation.
Let's also quickly touch on their other strategic moves. The full ownership of Industrious and the J&J Worldwide Services deal.
Right. Buying all of Industrious is them acknowledging that hybrid work is permanent and the flex or hotelification of the office is accelerating. By owning the operator, they capture that margin directly.
And J&J Worldwide.
That expands their footprint in the extremely sticky, recession-proof U.S. federal government sector, the largest and most reliable property owner in the country. Both moves just reinforce that GWS resilience narrative.
Okay, we've seen the success stories, the M&A masterstrokes. But a full capital allocation report card has to include the controversial decisions. So let's talk about the cannibal strategy, their aggressive share buybacks.
CBRE is consistently one of the biggest share repurchasers out there. They authorized another $5 billion program in late 2024 and have already bought back around $663 million in 2025. It's a huge boost to their earnings per share numbers.
Yeah, this is where the skeptical investor has to push back. If we go back to our ROIC analysis, they're trading at a 21x PE and operating with a negative economic spread. Is this really the best use of capital?
That is the central conflict. From a pure financial theory perspective, when your ROIC is way below your WACC, the highest return investment you can make is usually paying down debt or just stopping acquisitions until your internal returns improve.
So buying back stock at a premium valuation while destroying economic value on your existing capital is, well, it's arguably dilutive.
It is. Management's counter-argument, though, is that they believe the intrinsic value of their new integrated platform is fundamentally misunderstood by the market. They're saying the stock is cheap based on their projections for future cash flow, which justifies the buybacks as a high-return investment.
So you have to hold two contradictory ideas at once. The business model is superior, but the quantitative returns right now are insufficient.
Exactly. The buyback decision is less about financial optimization and more about management's very high conviction in the long-term story.
Okay, so let's pivot from the good and the questionable to the ugly part of the report card. And this is the single biggest financial disaster in their recent history, the Telford Homes failure.
This is a critical risk factor, and it really exposes the dangers of a capital-light services company dipping its toe into principal investing. In 2019, they bought Telford Homes, a UK residential developer, for about $337 million. The idea was to get into the London build-to-rent market.
And it was a catastrophic failure of due diligence on regulatory risk.
Precisely. After the Grenfell Tower fire, the UK government enacted the Building Safety Pledge, forcing developers to pay for remediating historical defects. Telford was forced to provision a massive sum, $143 million, for these unforeseen costs.
Which led to an enormous loss.
An enormous $193 million loss in 2022. And ultimately, CBRE had to take a full impairment of the goodwill and trade name, a complete write-off of over $48 million.
The lesson here is unavoidable.
It is. The capital-light services core is low-risk and cash-generative. The real estate investment segment, the REI segment, carries unpalatable balance sheet, regulatory, and execution risk that is just completely foreign to the core business.
So for any investor modeling CBRE's future, you have to heavily discount or maybe even ignore contributions from that volatile REI segment.
You have to. It's a permanent anchor on the risk profile. It showed their internal risk controls for that kind of investment were just not sufficient.
Okay, so despite the volatility from REI, CBRE trades at a premium. And that's because of the structural competitive advantages, the moat we talked about. Let's dig into the specifics of that. What makes their scale so defensible?
It starts with sheer global reach. As we said, they service over 90% of the Fortune 100. When a global company needs uniform, high-quality service in 50 or 60 countries, from Shanghai to São Paulo, only CBRE and maybe JLL can reliably deliver that.
Smaller rivals can't match that enterprise-level standardization.
They can't. But the real defensibility goes beyond geography. It's the data and technology platform that creates the highest switching costs.
The Vantage platform.
Exactly. Vantage is the operational brain of the fortress. They capture proprietary data from every single square foot they manage globally. Vantage aggregates all that info, combines it with advanced analytics, and it creates this sticky ecosystem where CBRE acts less like a vendor and more like an integrated strategic consultant.
So clients start relying on their insights for capital planning and strategy.
Yes. It's operational entanglement through technology. They can leverage router data to track real-time occupancy, for example. And once a client bases their strategic planning on the Vantage platform, the cost and risk of switching to a competitor just becomes prohibitive.
This is why those GWS retention rates are over 90%.
That's the quantifiable proof of a durable moat.
So in this oligopoly where it's really CBRE and JLL at the top, how do they stack up quantitatively against the other peers?
CBRE has the largest market share and the healthier balance sheet. JLL is the main rival, trades a bit cheaper at around 16x forward PE, partly due to higher leverage, and then you have the high beta option, Cushman & Wakefield, or CWK.
And CWK trades much cheaper, around 10x PE. Why is that?
CWK is a pure cyclical play. They have more exposure to traditional brokerage revenue, and critically, they carry significantly higher leverage, often over 3.0x. That makes them much more vulnerable in a high-rate world. The market's decision to give CBRE a 21x multiple is a direct vote of confidence in that GWS dominance and safety profile.
Safety profile acknowledged. But we have to address the single biggest systemic risk that could shatter that premium: office obsolescence.
This is the existential threat, and you can't underestimate it. The market has permanently split. The prime Class A plus assets are doing okay. They have manageable vacancy around 14.5%.
The crisis is in the B and C grade space.
Exactly. The commodity office space faces an existential crisis. Vacancy is nearing 20%, much higher in some cities. These are zombie assets. Their value has collapsed to the point where they're fundamentally unfixable without massive, unprofitable redevelopment.
And even though CBRE focuses on prime assets for leasing, a collapsing Class B shrinks the entire addressable market and hits their valuation advisory fees.
It does. If a fifth of the total office stock becomes economically unviable, that systemic risk spreads everywhere. It's the biggest long-term drag on valuation.
All right, let's pull all these threads together for the final verdict. CBRE is trading at a quality premium, around 21.6x forward PE. Is there any room for that multiple to expand, or do future returns have to come purely from earnings growth?
The conclusion is pretty clear. The easy money from the post-COVID stability trade is already in the stock. Future returns must come from tangible earnings growth, not from multiple expansion. That multiple is already constrained by the negative RIC/YCC spread.
So let's define the upside-downside matrix for our investor. What's the bull case?
The bull case needs a couple of things to go right. Rates need to fall, and the secular growth has to execute. If that happens, capital markets comes roaring back, GWS and data centers keep growing double digits, and maybe EPS hits $8 plus. At a 20x multiple, you're looking at a $160 stock price. So manageable upside from here.
And the more concerning bear case.
A bear case is that high rates persist and that office obsolescence risk accelerates. In that world, EPS stagnates around $6. And given the ROIC problem, that multiple could easily compress back to, say, 15x. That gives you a $90 price target.
A potential downside risk of 45%. That's a pretty scary asymmetry.
It is, which is why, given that risk profile and the tension between the great business and the tough financials, our final recommendation is a hold long-term, accumulate.
Me.
This is a blue-chip operator in a challenged neighborhood. The advice is to be surgical. Accumulate shares only on weakness. Wait for a market pullback that pushes the valuation down into that more defensive 16x to 18x PE range. That builds in a margin of safety.
So to summarize this whole deep dive, CBRE has fundamentally transformed itself. It's gone from a volatile broker to an essential corporate utility, anchored by those sticky GWS contracts, and pivoting into these powerful tailwinds like AI and infrastructure.
The resilience of the business model is undeniable. But, and it's the same but, that resilience has to be converted into economic value. The critical challenge for management in 2026 is reversing that alarming negative ROI-CBACC spread.
So for you, the investor, let's give you the specific, actionable data points to track over the next 12 months. The things that will signal whether they're steering the ship in the right direction.
First, you have to watch the GWS margin trajectory. Are the cost cuts sticking, or is wage inflation eating away at them? Second, track office leasing volumes, but focus on the absorption rates for Class B and C assets, not just the glossy Class A numbers. The health of the whole fee pool depends on those zombie properties.
Third, scrutinize their capital allocation discipline. Are we going to see more smart, high-return deals like TNT, or are they going to chase another dilutive failure like Telford Homes?
And finally, the most important number, the ROIC trend. Look for concrete evidence that the ROIC-DUEC spread is turning positive again. That spread is the ultimate long-term compounding metric.
That completes our blueprint for tracking CBRE.
And I'll leave you with one final provocative thought to mull over. It ties the Telford risk directly to the future of the platform. The Trammell Crow development pipeline is massive valued at $18.8 billion. This is largely an off-balance sheet asset that could represent huge hidden value. But to facilitate that pipeline, CBRE carries a massive $1.32 billion in off-balance sheet guarantees and contingent liabilities on that development arm.
So they're on the hook if those projects fail.
Precisely. Telford showed us the risk in development, so the question you have to ask yourself is, does the potential for hidden value from that $18.8 billion pipeline truly justify the massive disclosed contingent risk of $1.32 billion that CBRE carries on its balance sheet? It's a profound trade-off between speculative value and balance sheet stability.
Food for thought indeed. Thank you for joining us for the deep dive. We'll catch you next time.